As we go down, tax trap number one, the RMD. So I've had clients ask me, like we tried to figure out if they're going to be in a higher or lower tax bracket in retirement. And I say, I can't say for sure that you're going to be in a higher tax bracket, but I can say if the bulk, like the majority of your retirement funds are in pre-tax investment accounts, it's a very good chance that you're in a higher or the same tax bracket in retirement because of required minimum distributions. So any money that's going into your pre-tax 401k, your IRA, anything, your 403b, anything that's deferred tax, you're going to be forced to take a certain amount of money out at age 72. Now, by the time those of us who are not 72 get to 72, they might have pushed it a little bit further, we can hope, but it drives you up the tax brackets just like your income does. So that plus Social Security can often mean that we're in very similar tax brackets then as we are in the last few years of our work.
That's if tax brackets don't go up to say pay for, let's just hypothetically say the government's been doing some spending as of late. And they were doing a lot of spending before. But one thing that jumps out at me on this, and I talk about it in our philosophy conversations with clients, Corey, about the 4 rules of financial institutions: get our money on a consistent, ongoing basis, hold on to it for as long as they can, and fourth, give it back as slowly as possible over the longest possible horizon of time. The institutions have gotten so good at implementing those 4 rules that for the IRS to convince us to take money out of these plans and pay taxes, the financial institutions got so good at saying, no, just keep all your money in the products that we offer. The IRS has had to hang this sword of Damocles above the head of every investor to make sure that you actually take money out of these products. Okay, on to number 2.
So we already talked a little bit about Social Security. Most folks think Social Security is tax-free. It is unless it's over a certain amount. Right, exactly. Right. It is unless it's not. How do I say this? So provisional income is a measure of whether or not Social Security is taxable. So you add up Social Security, half of Social Security counts toward that calculation. Any pensions that you have, any withdrawals from retirement accounts, any other income that you're earning. And so all of those things add up to just enough money. Then Social Security is up to 85% taxable. 85% taxable. There we go.
Yep. And so not being aware of that.
So let's say this another way. Social Security and IRAs, the two main tools, and when I say IRA, I mean IRA, 401k, et cetera, the two main tools that the government gives us for retirement actually work worse together the more of each of you have.
That's a really good point. And keep in mind, this article is called Tax Traps, and we're thankful to Kiplinger for writing this one. But the key on that is that with each of these first two, or any of these in this article, why is something a trap is because you don't know about it when you happen upon it. It's just something to be avoided once you know about it.
Right.
They're only traps if we're not informed.
And number 3, Medicare, I don't really think of it as a trap. It's just a thing. Because, so what it says is if you pay a certain base amount for Medicare when you turn 65, and if you have higher income than $80,000 as a married couple, you're going to pay a little extra for Medicare. There's a add-on monthly amount. And by the way, they look 2 years back. So basically everybody is if you're over 80,000 of income to begin with, you're going to start at a higher rate for Medicare for the first couple of years than you probably will have long term. But we've looked at it with clients, clients that want to do Roth conversions and other things that generate a little more income leading up to 65 and beyond. And it makes them pay a little bit more for Medicare, but the net benefit is still greater for them to do so. So it's not necessarily, this one, I don't know that I would call it a trap, just a thing to pay attention to. You might want to just do it anyway. Like most real traps, you don't just walk into a bear trap and not care about it. You have to stay out of it. This one, it's not so bad if you trip it up. It's like putting a mouse trap on the floor and you step on it.